Welcome to Commercial Real Estate Now in partnership with CBRE Econometric Advisors and my co-host Dan Diebel. I'm Carly Iacono. Dan, great to see you. How are you?
Carly, doing well. Great to see you again. Always happy to be here. Always happy to chat economics, retail, and everything else and try to get through the shrouds of mystery that we're going through right now.
Who doesn't love to chat economics and retail? I mean, come on. If those are not hot topics, I don't know what is when we put it that way.
You can ask all of my former students. I would say, as far as the reviews go, about 10% of them really never want to talk economics again. But other than that,
they never did to begin with, but we're going to discount them.
Yeah.
The rest of us, we're in, and happy to see you for another month of economics and retail. Always good. So we're going to jump right in today. And today's topic is the shrinking retail footprint. I feel like we need a really alarming, catchy title like Honey, I Shrunk the Kids with some like dramatic music, behind a good old 90s movie. But since we don't have it, I think we just got to get right into it. How are retailers' footprints changing and why? That's what we're going to cover today. So before we go into all of the whys and the data around the changing footprint, I look at this topic in two buckets, and maybe we can cover both. The first is retailers who are downsizing their core prototype, right? They're really core to their business model is going from 80,000 to 50,000 square feet. And I have some examples of that. And then bucket two is retailers who are adding a small footprint prototype to their sort of mix of choices when they're looking for new locations. And to me, those are two very different scenarios, right? Different motivations, different outcomes, et cetera. So there is a lot of talk about retailers' store footprints shrinking or downsizing, but I think why is multifaceted in the response.
I agree with you, especially on the Honey, I Shrunk the Kids reference, but I won't go back there. There have been ant battles in my backyard for a while, so that really brought up the
really
Honey,
triggering.
I Shrunk the Kids earlier. I was literally thinking about it in my garage earlier today. Anyway,
sorry.
The two reasons for retailers kind of shrinking their footprint. Now, they're not shrinking their number of stores. Most retailers are still going to be net expansion. Even though last year was the first year, there were more announced closings than openings of retailers by Core Site Research. But overall, retailers are still in expansion mode. They're just expanding with smaller footprints. I think that the recent history of events has actually really pushed both of the two types of smaller footprint stores that you mentioned.
And I think it's, sorry, go ahead.
Part of it is from necessity, and then part of it is from opportunity.
And that could be kind of going down those two paths, right? Necessity or maybe efficiency of changing their current prototype and opportunity, the smaller stores reaching customers or markets that they previously hadn't, is my guess.
Yeah. So I think that the first push into these smaller stores, now retailers are constantly experimenting with new things and trying new things to capture market share and improve the consumer experience. So that is all constantly going on. But I think that the pandemic really gave retailers a chance to reset. Now, most of the space that was launched back into the market for retailers during the pandemic had a smaller footprint. And that forced retailers, if they wanted to expand, to consider how they could expand into this smaller footprint.
Just give me a quick data point on where availability is now compared to pre-pandemic? Because I'm sure that's part of the story as well.
Yeah. So, you know, if you have been around retail commercial real estate over the last decade, basically, we've been talking about how availability is on the decline. Available space is low. A new historic low, a new historic low, a new historic low. It's been on a tear since about the mid 2011, where we saw a decrease in availability of about 33% over the next 9 years, of course, until COVID hit, and then once we shut down, we did see an increase in availability. But if we compare the last 5 years, 4 years coming out of COVID to pre-pandemic, available space is 25% lower than it was pre-pandemic. So there's just less and less available space. Most of the retailers that were moved out during the pandemic were smaller retailers. The grocers all stayed in place. The larger anchor tenants mostly stayed in space, with the exception, of some of the struggling types that have been struggling for a long time. We won't discuss very much here, but that left all of this smaller space, and it left this smaller footprint space in the suburbs specifically.
And just real quick on that availability, does that 25% take into account the obsolete space or retail that's been counted obsolete, or does it not? Because that was I think, fascinating topic that we covered last month. So is that in that number or no?
It is not. So we're not
Okay.
including obsolete space. Now, the reason why I'm not including obsolete space, oh, this is going to sound like a humble brag, is because none of the other shops have it yet, and they're not accounting for it. And if I were to quote availability and it doesn't come close to the other shops, right? Because obsolete space has tripled since
Mhm.
pre-pandemic numbers. So that's going to throw these numbers off from other comparative numbers. So we're just talking the normal comparative kind of availability of this suburban space, not including the obsolete space.
But I'm sure if anyone wants to get more granular on this, you have all the data. So if you're listening and you're like, wait, I want the numbers with the obsolete space, just call Dan. He'll give them all to you.
Yep. Oh yeah. Uh-huh. You just let me know. Please reach out.
Okay, so we've covered
Yes.
that. So we've got really high, um, I guess, availability. Wait, really low availability. There we
Mhm.
go. 25% tighter than it was pre-pandemic. Do you think that's partially driven as well by lack of construction, along with retailers expanding or trying to expand at an increased pace? I would assume they go hand in hand.
Yeah, they do go hand in hand in this case. We've seen construction just basically bottom out post GFC. Some of the retail that was being built was finished, and then we're at record low levels of new construction, and they keep getting smaller and smaller. I'm gonna have to think of a way to remake graphs if they
Right.
continue to get smaller and smaller.
Right.
So yeah,
So the episode's not really about availability, so I don't want to get too hung up on this.
right.
But it does lay an important framework for what we're talking about, which is why retailers are shrinking their format, and that's certainly one of the main drivers. Now, what do you think some of the benefits are? Because I think there's an immediate, if you're not in the industry or maybe don't look at this every day, there's an immediate negative connotation. Retail footprints are shrinking, bricks and mortar is less important. We know, because we talk about this every day, that that is very much not the case. So why don't we run through some of the positive benefits retailers have experienced from downsizing their prototypes?
Yeah, so there are a bunch of positives for downsizing either their prototypes or experimenting with new store format new store formats altogether. One, it allows them to be more agile. They can now move into smaller suburban suites or even consider moving into urban suites because they're familiar with smaller footprints and tailoring their curating, I should say, their collection of goods to the consumer, which allows for less retail space. Further, with a unified model of commerce, retailers don't need as much square footage. They don't need as much inventory space, and they don't need as much floor space. They they can satisfy their customers through a variety of avenues, and the brick and mortar just acts as an interaction place, essentially, less so than a marketplace necessarily. The marketplace takes place online or through the phone or mobile, and then you just show up in store for the final product sometimes for some of these new smaller formats.
So,
Also, with smaller space comes smaller outlay of expenses. So
right.
you can get better margins on smaller space and still serve a wider area of the population. Right? If we think about breaking, let's say totally theoretically, we're breaking up a 50,000 square foot store. Well, if we look at that same trade area, and we can actually break that down into 10,000 foot stores, we could essentially service an even larger trade area. Or we could break it down into just 10,000 square foot stores and service a larger area because we're more specialized with our data and we really know our consumers in that area well as the retailer.
So it
So
sounds like it's
lots of
a
positives.
mix of efficiency that's allowing the retailers to operate productively out of
Mhm.
smaller square footage. That's probably driven by a lot of consumer data, a lot of data on their inventory and how to turn it and when and what product mix works best, right? So it sounds like the retailers are becoming more efficient, while at the same time, as you just mentioned, saving significant costs, right? I'm sure there's a benefit in labor, definitely a benefit in rent, operating costs. So it seems like it's really beneficial both sides. What are we seeing? And I'm not sure if we have this data, but what are we seeing on sales per square foot? Do they change on these smaller footprints? You had mentioned that some of the locations are more showrooms or consumer touch points, but maybe it's leading to an online purchase, which I know tracking sales in that scenario becomes a little murky. But
Mhm.
are we seeing the stores be more productive per square foot of space because of these other efficiencies? Or is the metric a little bit different if it's more of a touch point?
I have Wow, so many good questions there. Uh, I of the data that has been shared with me, yes, revenue per square foot is up. The halo effect is very real. All of the data I've seen on it confirms that when a retailer with an online presence opens a new store in an area, their online and brick and mortar sales go up, and that's regardless of whether it's a touch point for exchange of goods and services, or if they're doing that exchange physically in person at the store. Both of those things increase when you open a new store and are connected to your consumer base well through mobile or other avenues. Uh, in terms of just kind of an overall view, all retail has become more productive per employee over the post pandemic. So basically, employment within the retail sector has stayed essentially flat, but retail spending continues to increase. Well, that means more retail spending is going to the same amount of retailing, or the same amount of retailing employees are creating more retail spending. So retail overall is becoming more productive per square foot. we can certainly claim that as true. Uh, I can't say more about the specific smaller stores other than theoretically it should work out like that. And most of these smaller store concepts rely heavily on technology innovations to lower their labor costs.
I think you made another interesting point that if let's and I'm sure it doesn't always work out exactly like this, but let's say a retailer had a 50,000 square foot box and now they're doing 10,000 square foot boxes that allows them to reach more consumers. And I think even just from a product visibility or branding perspective, that would be very powerful, right? If you see, five of the same retail stores in your day-to-day travels, whether that's commuting or just going about your day on the weekends, you're more likely to think of them when you have a purchase need than if you maybe never pass or pass it infrequently. So something about having it closer to the consumer, I think would have just a branding and touch point benefit as well, in addition to being more productive on a sales per square foot basis.
Oh, I thoroughly agree, and retailers thoroughly agree with you too. I I don't know how you would collect data on that, but I
No,
think
but
that's an
makes
accepted
sense,
truth.
right? Yes.
Yeah,
So we all
yeah,
agree.
yeah, yeah. I
Good,
totally agree.
good.
Yeah.
Universal agreement. That never happens. So good. I probably should just stop the podcast now. I feel like that's great. Got to
Yep.
something everyone agrees on.
Well done. We did it.
Our work here is done. No, that's funny. So this makes sense. I do think there's going to be an inflection point where, you know, some stores are too small and maybe they go back up. So I don't know for every retailer that it's going to be smaller and smaller and smaller makes more sense. And that will likely be very brand and retailer specific. I was on the Kohl's earning call this morning, just for a quick example. Their main prototype is 80,000 square feet. Historically, they have some 35,000 square foot stores and some 55,000 square foot stores. And their leadership today said, we think 35,000 is probably too small and 80 is probably too big. We're really happy with our 55,000 square foot prototype. And that's going to be part of our focus. Not to say they're closing the other stores. They didn't say that, but they
Mhm.
were saying that middle square footage felt like it was working the best for them. And I'm sure there'll be some discovery as retailers downsize as to what is the most productive format for them.
Yeah. Yeah. I think retailers are going to discover a lot as they put these into a functional place in a more normal world. Like we're not bouncing back from
Yeah.
anything right now. Sure, tariffs are still swirling. There's still swirl in our political kind of atmosphere, but we're not looking for. We're not looking at. We're not looking at rising interest rates. We're not looking at some of these other things that would stop retailers from expanding. These expansions would also help improve their margins, which could help absorb some of the uh, inflation created by potential tariffs.
Hmm. And I know location wise, some of these urban markets are a little harder to access, right? There's just not as much available space as some of our suburban markets in terms of square footage
Mhm.
overall, right? The spaces are just smaller. So is there a part of this that is focused on target markets? And by target market, I don't mean specific, submarkets or cities, but just conceptually, are
Mhm.
you seeing more focus back on urban as compared to suburban? Or are we still seeing most of the growth in the suburban markets? And how does that play into the store footprint conversation?
Yeah. Uh, good question. I think that so we did see retail in the suburban markets just boom post pandemic because that's where everybody was. That's where their wallets were. That's where they were spending. So, of course, retail around where consumers are spending and where they bring their wallets is going to do perform well. With the return to work, we think that that's going to bring wallets back into the urban core. And investors are really starting to look at the urban core and try to figure out where in the urban core they can purchase, because, urban availability is higher than suburban availability now. And as we've discussed before on, our podcast previously, retail located around offices outperforms the market, regardless of whether it's in the urban core or not. And in those vibrant mixed use areas, retail also outperforms the market. So investors are starting to look at the urban core. The issue with that is it's really micro markets. Literally, one street corner is not like the next street corner. You could have exactly the same retail space, mirror image across from one another. And some of it could be considered Class A and the others could be considered Class C, just because of the block it's located on. So, the urban retail takes a lot more know-how, but retailers are looking at what they're calling neighborhood concepts or urban concepts with precisely what they learned from the pandemic turmoil, that consumers want a curated selection that serves them well, that they can get quickly. They want to be able to pick up in store, because we still want to interact with human beings. We just don't want to interact with them for, 15 minutes. Maybe we want 1 or 2 minutes of interaction instead of, 15 minutes of awkward conversation while you try on shoes or something.
Pretty funny. I'd like to see the psychology behind that. We like people, but only for 1 to 2 minutes. Beyond that, no, sorry. We'd much rather have a robot.
Yeah,
That's good.
I like to deal with people in those situations because the robot always answers the wrong question.
Right.
It always sends me to some like FAQ that I've already read or
It
something like
doesn't
that.
help. Right.
Yeah.
Right.
It's
All
so
right.
much easier to have a person be dynamic, but AI agents, I think, will solve that problem in the future.
All right. So we're still on board for 1 to 2 minutes of human interaction in an efficient store format,
Yes.
unless you're a little more friendly than you are, right? Unless people really crave that interaction. But we'll just leave that. We'll leave that. We'll try not to talk that much
That's
longer. We're well over the 2 minutes right now. I just want you to know.
that's fair.
Yeah.
Yeah.
Okay, so urban is a focus as people, if I'm hearing you right, as they return to office or working
Mhm.
from the office. We think retailers are going to look at this again, not like they really ever completely left, but maybe this is a new growth or enhanced growth area for them as the
Yeah.
office becomes more important again. Is
Mhm.
that the gist, we think?
Yeah, like office occupancy is sitting around 50% of what it was pre-pandemic. About 25% of days worked are worked from home in terms of like surveys that have been done around work from home and return to office. So we're settling into kind of a known amount of office users and commuters and everything like that. So the urban is going to be revitalized, but mainly around these offices that are drawing in more foot traffic and more wallets. Similarly, and like again, we don't need to say this to anybody that's been around retail. Strip centers, convenience retail, all of those smaller, quick grab and go kind of retailers have been doing incredibly well. Any of those positioned along commuter routes, I expect to do incredibly well in the future here shortly as we settle back into normal commuting habits. But I don't think that there's enough settling back into commuting habits to disrupt the uh,
Suburban. Mhm.
suburban
Yeah.
uh, flourishing as of recent. Of course, that's going to slow down, but that's all because of space, not necessarily demand.
I think that's a really good point that you said quickly, right? That the focus is shifting not because of lack of demand, but lack of space in suburban markets. And retailers need to grow and need to expand. So maybe they're trying to make those commute routes and urban areas work again as sort of the next old frontier, right? The new old frontier, something like that.
That can be the next Star Trek, the new old frontier.
So we're just full of good ideas today, full of them.
Just coming off the top.
Yeah.
Yep.
What do you think all of this means for investors? We've talked about how retailers are trying to grow, how they're adapting their footprint, how they're becoming more efficient and profitable per square foot. If you're an investor looking to buy a retail property, are you changing any of your analysis or metrics if you think that footprints might be shifting? Any considerations there?
I think that investors, so I would be remiss. I have to say it every time. Grocery anchored retail is going to continue to do well. It's going to continue to be the shining star of retail. We don't see, in fact, it's only going to get better because if you can fill more of that inline space with these new formats, you can bring more vibrancy to your center. A lot of these new formats are being explored by creditworthy tenants, which investors also love in their centers. So all of those are going to do incredibly well. I think in the urban areas, you have the most risk, but the most opportunity, which is often comes hand in hand when assets are appropriately priced. But the urban availability stayed steady from Q4 to Q1 for the first time, and we've kind of been just seeing it go up and up post-pandemic. And it stayed relatively flat over the last 2 quarters, which means there's some stabilization down in this urban core, which means now it's time to look for space. And those spaces that may be open and could get marked up to market rents. We're seeing when rents are brought to market anywhere from 30 to 75% markup. I'm sure there's more. I've heard
It's huge.
Yeah. I've heard investors claim higher markups, but everything with a grain of salt. I don't think 175% markup is realistic for anybody else to expect, regardless if this individual has made that or not. So, yeah, I think that looking at those urban places where we expect to see more footfall and increase traffic are going to be the way to go. Similarly, these strips and essential services, any sort of the convenience retail, urban retail with well-curated collections should do well, but you really have to get the right retailer in there that knows their demographic and knows that their demographic is around in that neighborhood or community. Suburban retail is going to continue to do well. We may see some of the larger spaces, the larger formats like power centers, get a little bit stuck in the short term as they've experienced some short-term swirl around bankruptcies. But power centers offer an interesting opportunity, but oftentimes their buildings are spread out and sometimes they have multiple anchors with multiple inline spaces, which could do well, especially if some of those are inline spaces with drive-throughs. Drive-throughs are still an amazing thing to have. Americans love drive-throughs like nobody else. I may have said this before, but we will sit in a drive-through for longer than it takes us to go in, order, and get food and leave.
Yeah, exactly. Yeah. Much longer, I would say. Yeah.
Love a drive-through.
The other thing we're hearing from the ownership side is clients who already have these centers who are getting some of those boxes back due to the bankruptcies that have happened are ecstatic, right? Because not all the time, but a lot of the times, because they can, like you said, mark the rent to market, or they can subdivide and get a much higher rent per square foot than they did with one contiguous box. So it seems like there really is opportunity for either backfilling as is, but more often than not, subdividing and really boosting that rent. And maybe that was the 175% story that you heard from one client. There could have been some creative positioning of the asset that
Mm.
really did allow them to, you know, increase rents by that much. Could be true, might just not be a tale. Um, and
Yeah.
I think that, so if you already own the property, this is very good for investors. And if you're looking to purchase, finding some of those larger spaces with below market rents, although not easy for sure, not easy to find. But if you
Right.
have good co-tenancy and a great location and anything with below market rents or maybe a larger square footage that could be subdivided, that's really opportunity.
Yeah, absolutely. And I think that mixed use has kind of suffered from a little bit of overdevelopment sometimes and putting in use cases that aren't necessarily great. But a lot of this mixed use was developed for commuters, essentially, to
Mm, right.
commute easily into the main central business district or core. So I expect a lot of this mixed use as well around some of these commuter lines to do incredibly well uh, after struggling post pandemic because a lot of the mixed use was based around the additional benefit of ease of commute.
Right.
Yeah. So
And
really mostly
maybe
positives here.
another episode, but I'd love to hear how far people are willing to commute now and if the commute has changed, because I think that affects where retailers open as well, right? I believe right after the pandemic, that was the focus, that either work from home, but if you are going to go back to an office, that office better be fairly close to your house. So I wonder how tolerant the American worker is becoming of longer or pre-pandemic length commutes, or if we're still pushing it back on that.
That's that's a
Interesting.
really great question. I remember when I was in grad school, a paper around commuting and marriage outcomes, and I think
That's
that like
funny.
once your commute past 45 minutes a day or 45 minutes each way, I forget exactly, your probability of divorce like ticked up incredibly. So
Wow.
I wonder if anything like that has changed as well. I haven't read anything, but that's a great thought. Like
Yeah, I
my,
think we need
I,
to
s-
dive into
I
that
yeah, I certainly am
better.
willing to commute less than I was before,
Right.
uh, post pandemic. But also, technology's come a long way in
Right.
that, like we were discussing earlier about how being in person still has benefits that online conversations don't have.
Right.
But much of what necessitated in-person interaction in the past is no longer needed because we do have all of these technological
Tools. Yeah,
advances.
for sure. All right. Well, we will pick that conversation up on a future episode. We'll have to get our data together, but the future of commuting. So stay tuned for that. But to wrap up today's episode on the shrinking store format, it sounds like it's really positive, both for investors, for retailers as they become more adaptable, more flexible, more profitable, right, on their margins, and for cities and suburban areas that the retailers might want to go into because now they have more options in terms of their prototype. Any negatives, any challenges, anything we didn't cover before we wrap up?
Yeah, I, the negatives are going to be if demand dries up. If retailer demand dries up and we don't see new business formation at a similar level as it has been, because it's near all-time highs as well. If one of those two things starts to dry up, then maybe we'll see negatives because retailers will be downsizing space and there will be nobody to backfill. But we're not experiencing that yet. Certainly, there's still healthy retailer demand for well positioned spaces.
And let's hope that that continues. It looks like it's going to. So,
It looks like it's going to, fingers crossed.
yeah, exactly. Fingers crossed. All right, Dan, so good to see you. Thanks for all that wonderful information. We appreciate it. I think it's a really interesting story on the benefits of smaller store footprints. So thanks so much.
Thanks so much for having me. Always a pleasure.
To everyone listening, that was Commercial Real Estate Now with CBRE Econometric Advisors. We're so happy you tuned in, and we look forward to seeing you again next month. Have a great day, everyone. Take care.